Okay, so let's look at this recording process illustrated in terms of all those transactions that we were first introduced to in the beginning part of this chapter. So if you remember those events, event 1, October 1st, stockholders invested cash in the Sierra Company in exchange for stock. So we've done the analysis already. That was the early part of the chapter. The effect on the accounting equation. This is the debit credit analysis. So since debits increase assets, we have to debit cash. Since credits increase equity, we credit common stock. Here's how the journal entry looks in the journal. And posting this transaction or this journal entry would look like this, with $10,000 going into the debit side of the cash account because it's increasing the cash balance, and $10,000 going into the credit side of the common stock account because it's increasing common stock. Remember, common stock goes up with credits, so you credit it to increase it. So the rest of this section here goes through all those events and goes right through the logic, getting you down through the journal entry and into the posting of this. So in this case, they borrowed money by signing a 3-month 12% note. This interest, by the way, is a later event. We don't have to worry about this 12% interest right now. That will add up and be recorded later. So in this example here, when you borrow money by signing a note, your cash is going up, so you debit cash. Your notes payable is going up. It's a liability, goes up with credits, and that's credited. And then when you post this transaction, you can see the 5,000 adding to the cash balance, and the 5,000 adding to the notes payable balance. Notes payable is a liability. Anything payable is a liability, and it goes up with credits. I'll just do one more here. On October 2nd, Sierra used 5,000 cash to buy equipment. We've done the analysis already. Equipment going up means we have to debit it because equipment is an asset. Assets go up with debits. When we get rid of cash or spend cash, it goes down. Credits decrease assets, so we have to credit cash for 5,000. So, and then if you look at what kind of transaction that we'd record, the journal entry, debit, equipment, credit, cash. And then when you post this journal entry to the relevant accounts, you see that now we're crediting cash 5,000 and we are debiting equipment 5,000. Always keeping debits and credits equal. I'll probably say that a lot over the course of these voiceovers. Debits must always equal credits in every single transaction that you record. Because if you think about it, if you think about the accounting equation, I don't have one handy here, but if you think about the accounting equation with assets on the left and liabilities and equity on the right, really you can kind of say debits on the left and credits on the right. So debits and credits have to always be equal, just like that accounting equation had to be equal. So you look through the rest of these events and see if you can make sense out of the journal entry and the posting of all of these transactions. And let's see if there's anything else down here to talk about. Nope, that's it. Practice hard on this chapter. Get to know debits and credits very well across all the different kinds of accounts that you come across. This is a skill, this journalizing of transactions. This is a skill you're going to need to use in every single chapter, just about every single chapter that we do in this class, and a lot in Accounting 212 if you have to take that class. And if you're an accounting major, this is the building blocks of every class you ever take in accounting. So this is crucial that you have a good understanding of this stuff.